Hello, and welcome to another episode of IJS Speaks. This is your neighborhood financial economist, Katie Mark. Today is July 10th, 2021. It is 2:17 p.m. Eastern Standard Time. Today, I want to start off by talking about long-standing relationships in financial markets. So typically you hear about the generic 60/40 portfolio. Well, the whole reason why an investor should hold both stocks and bonds is because typically they are negatively correlated, which is to say that when stocks are up, bonds typically are down, and vice versa. What we saw in Q2 was quite the opposite. On most days, now not every single day, but on most days that stocks were up, bonds were also up as well. And just to be clear, when I refer to bonds, I'm making a generic statement, but more specifically, I'm referring to the US 10-year Treasury. And when I refer to stocks, I'm making a generic statement, but I am more specifically referring to the S&P 500. And what I noticed for most of Q2 was that they were moving together. So that inverse relationship had completely broken down, and there were times when I would look at the correlation between an S&P 500 E-mini futures contract and a 10-year Treasury futures contract, which for all intents and purposes, a perfect one-to-one correlation. In that time, I also noticed that there was a relationship developing between gold and the 10-year Treasury. And looking at those two asset classes, the one thing that they tend to have in common is inflation expectations. So when I observed both gold and the 10-year Treasury moving in tandem with each other, I assumed that it had something to do with how investors' expectations of inflation were manifesting in financial markets. Once the Fed started talking about tapering monetary accommodation, we started seeing market mechanisms realigning themselves to a more normal view of monetary policy. And I think that markets are doing this because the Fed is also doing this. For close to a decade, maybe a little bit more, the Fed has been one of, or if not the largest participant in the market for US 10-year Treasuries. They have been a huge buyer to the tune of hundreds of billions of dollars every month in purchases. That type of buying over a decade created huge distortions in financial markets. The thing worth considering is as the central bank starts unwinding accommodative monetary policy, how does the ultra accommodative stance that fiscal policy is taking going to offset those market forces, or at least act as a countervailing force to those market forces that tightening monetary policy exerts? The Fed has been pumping trillions of dollars into the US economy. Central banks around the world have been pumping trillions of dollars into the global economy. Now they're looking to take some of that money off the table. At the same time, governments and other fiscal authorities, in response to COVID, have pumped trillions of dollars into the global economy. So, on one end of the lever, we have tightening, and on the other end of the lever, we have accommodation, with financial markets stuck in the middle to decipher a direction. As with most weeks, I was trading options on the SPY ETF, tracking the S&P 500. I was also trading options on the GLD ETF, tracking gold. I traded options on the USO ETF, tracking oil. And I bought options contracts on the 10-year Treasury and a micro Canadian dollar futures contract. Options trading on the week was flat to maybe realizing a small loss, and it was for a simple reason. I did not record a podcast last week. Typically what I do as I'm recording my podcast, I reflect on the previous trading week in the trade book section. But then I make my way to the dashboard and the forecasting section of the podcast, where I walk through my analysis for upcoming trading sessions. I really do use this information. This is how I pick my trades. So I basically went into the trading week that just ended using the same analysis from the previous trading week. Well, as the market is realigning itself, 2-week-old analysis isn't very good. All in, I made a little bit of money on the SPY, made a little bit of money on gold. I think I lost some money in oil, lost money on the 10-year and on the Canadian dollar. The money that I made trading this week did not offset my losses, so I think I had a small loss on the week simply because I was trading with an outdated analysis. This week, I started focusing a little bit more on the passive side of the portfolio, because looking at the S&P return so far in the year, we're looking at 14 to 16%. So just buying the index seems to make a lot of sense when the market has been trending the way it has for the last decade. So in addition to trading derivatives on the SPY, I've also started parking money in a couple ETFs that track markets around the world. The beta on those ETFs are pretty high to the S&P 500. So on a typical day when the S&P is up, the ETFs tracking indexes from other countries, other regions are typically up as well. And vice versa, the day the S&P is down, those indices are typically down as well. So the objective is to capture a bit of beta, passive beta from the S&P 500, as well as a little bit of alpha from having a globally diversified approach to the passive portfolio. Now, these are ETFs that I've held in the portfolio. I just haven't been committing capital to them. But looking at their performance and comparing the ease of return on the passive side versus the active side, I think it's worth going into the second half of the year, adding a little bit more passive exposure to the portfolio just to offset the risk that I take on the active side trading the derivatives. So just started adding to the positions. Of course, still holding on to my BLOK positions, tracking blockchain. It has been taking a beating lately, but it's an equity position because I'm not certain on a time frame. So my horizon is indefinite. Similar with my index ETFs. We'll start with Africa, AFK, FLGB tracking Great Britain, EZU, which tracks the Eurozone, ILF, which tracks Latin America, and lastly, IPAC, which tracks Pacific Asia. Just like the BLOK ETF, the other ETFs tracking regional markets have an indefinite time horizon, which is why I prefer to take a equity position in them, because with the derivatives, you add the time factor to the equation with the expiration date on the contracts. But as a result of all the stimulus that has been pumped into the global economy and the type of inflationary pressures that it has the potential to create, I think it's worth building an equity base that has some exposure, and especially on the international side, because in most cases, developing and emerging markets like in Latin America and in Africa will outperform more developed markets like you'd find in Great Britain and in the Eurozone. And then, of course, Pacific Asia has a lot of emerging and developing economies that influence growth in the region, all which stand to benefit from a growing economy and increasing inflationary pressures. Towards the end of the week, when I finally got an opportunity to focus in on the dashboard, on my charts, reevaluate, and basically once I start taking a bunch of losses or having a bunch of misfires on trades, that's my cue to pivot back towards my charts. That's where the work is done. That's where the analysis is done. That's where I get to determine what went wrong and also what do I do next. So, reverting back to my charts late in the week, after realizing losses all throughout the week, I had to do a little rearranging, a little housekeeping. What I started noticing was some older relationships that I used to observe in financial markets are now re-exerting themselves. So we'll start with safety and liquidity. The 10-year Treasury is trading below its regression curve ribbon, which signals to me that the price is accelerating lower. It's trading below its pivot indicator, which also signals to me that the price has more resistance than support. Its linear regression slope measuring momentum is negative and getting more negative. And its linear regression slope measuring trend is positive, but getting less positive. So it is steadily sloping towards the zero line, meaning that if the price action continues in the way that it has towards the last couple trading sessions, the trend will inevitably go negative as well on the 10-year Treasury. So coming out of last week, 10-year Treasury prices were actually making higher highs and higher lows. Into Thursday, it made its high, but the Friday session rolled around, and instead of making a higher low, it made a lower low, and then proceeded to make a lower high and a subsequent lower low. So from those that are familiar with technical analysis, when you're looking at trends and you see a break in the pattern of a trend, either progressing higher or progressing lower, you typically start looking for other signals of a reversal. Looking at the dashboard, the 10-year Treasury appears to have made a short-term peak very early in the Thursday session, So in the short to medium term, the dashboard is signaling some weakness in the price of the 10-year treasury. Investors will be selling the safety of the 10-year treasury. When it comes to liquidity, we have a similar story. The dollar index itself coming out of last week was trading sideways. Its highs and its lows were, for the most part, in line with each other, which also means that the regression curve ribbon has been oscillating, and the price itself on the dollar index has been oscillating around the ribbon, highlighting sideways movement. The pivot indicator has been oscillating back and forth from support to resistance, again just highlighting sideways movement. So from the price action itself, not a very clear picture. It just looks like a lot of sideways movement. The linear regression slope gives you a little bit of a glimpse, however. The slope measuring momentum, it's negative, but it has been oscillating back and forth from negative to positive throughout the week. Similarly, with the regression slope measuring trend is negative and has been oscillating back and forth between positive and negative all week. But to end the session on Friday, we have the price below its regression curve ribbon, so it's accelerating lower. It's below its pivot indicator, which signals that the price has more resistance than support. Its momentum is negative and its trend is negative. Looking at the full week's worth of data, it looks like the dollar index has been bouncing back and forth in a sideways range. Looking at the last couple sessions, Thursday and Friday, it looks like the dollar started accelerating lower. If that trend continues, then more than likely the dollar will break through the lower bound of its sideways range. So from a trade decision standpoint, I would not want to enter a position on the dollar until it breaks out either the top of the range that it's been trading sideways, so I know that it's accelerating higher, or break through the bottom of the range so I know that it's accelerating lower. Now, because of its relationship with the 10-year treasury, and because the 10-year treasury is signaling a move lower, I'm inclined to believe that the dollar is also signaling a move lower. The timing on that move, however, is questionable because these relationships are just starting to reestablish themselves and re-exert themselves. So what we could end up seeing is, as the relationships strengthen and weaken, the timing of the moves across asset become more disjointed, and one may happen long in advance of another, or they could happen in tandem with each other, or anywhere in between. But looking at how both the dollar and the 10-year treasury closed out on Friday, both asset classes seem to be signaling weakness going into next week's trading session. So the 10-year treasury, looking at the dashboard, looks like a clear short right out of the gate. The dollar index, from a charting standpoint, we do need a little bit of chart pattern confirmation. If we can get a breakout of the sideways channel, that can confirm the momentum in one direction or another. But looking at cross-asset relationships, if the 10-year treasury keeps moving the way it's moving, then more than likely the dollar will move in line with both of those asset classes moving lower into the start of next week's trading session. On the risk side, I'm looking at gold, the S&P, and crude oil. So over the week, gold has been drifting higher. Not a very steep incline, but still an incline. It technically has been making higher highs and higher lows. Tuesday into Friday, the regression curve ribbon on gold has been moving sideways, and the price of gold has been oscillating around that ribbon with a slight upward bias. Well, as of close on Friday, the price is using its regression curve ribbon as support. It's above the ribbon, which signals to me the price is accelerating higher. Its pivot indicator, however, is above the price, which signals resistance. Now, because the price has been moving roughly sideways, the pivot indicator has also been oscillating back and forth between support and resistance. The linear regression slopes, however, measuring momentum, has been sloping lower for most of the week, but not only did it break the downward trend in its slope, it also went positive on Friday. The linear regression slope measuring trend is positive. It has been positive, but throughout the week has been getting less and less positive. From a charting standpoint, I did want to highlight a break in a divergence on gold. Now, divergences and convergences are important to consider because they tend to signal ahead of time that the price is getting ready to break out. So what I've been looking at is the tops on gold, or the highs, and I drew a trend line connecting two peaks, and that trend line is sloping upwards. Then I look at the linear regression slope measuring momentum, and I draw a trend line connecting tops, starting roughly at the point corresponding with the first top on the price itself that I connected with the trend line. Except that the highs were getting lower on the linear regression slope. So I have the price making new highs, but the slope on the linear regression making new lows. There's a divergence. Those two things should be moving in the same direction. They don't always, but they do eventually. So the goal is to look for one of those trend lines to break. So either the price of gold breaks down and trades away from the consecutive tops that I highlighted with the trend line, which would correspond with a downward sloping regression slope, or the trend on the regression slope breaks and it moves higher to get in line with the upward sloping price. So the direction on any given break, whether it's the price or the indicator, typically signals the direction of the moving price. In this case, the linear regression slope broke its downward trend and also crossed into the positive. So that signals to me that I can expect the price on gold to start accelerating higher to reflect that upward push in the linear regression slope. Coming back to those long-standing relationships that I talked about in the beginning of the podcast, the dollar and gold typically tend to have a strong inverse correlation, so they move in the opposite direction. That relationship exists in most cases, but not all. I have seen trading where the dollar and gold are both moving in the same direction at the same time. Doesn't typically last forever, but it doesn't mean that it's going to go away immediately when it's doing that. The dollar and gold currently have negative correlation. Based on recent price action, they're moving in opposite directions. If I'm seeing signals on the gold market that are hinting towards a price move higher, that does correspond with a move lower in the dollar. So from a cross asset standpoint, I can use a move in gold to signal a pending move in the dollar, or I can use a move in the dollar to signal a pending move in gold. Now, if both markets move at the same time, I can position for that as well, but ideally you can use one asset class to forecast a move in the other one. This would be a good example of an opportunity to do that. Looking at stocks or the S&P 500, which is my other risk asset. For most of the week, the regression curve ribbon has been oscillating sideways, and the price has been oscillating around that ribbon. Similarly, the pivot indicator has been oscillating back and forth from support to resistance, again reflecting that sideways movement. So the overall picture looking back a week on the S&P is flat. Towards the end of the Friday's trading session, however, the price did accelerate above its regression curve ribbon, which signals that it is accelerating higher. Its pivot indicator is also trading below the price, which signals support. And the linear regression slope measuring momentum, which had been oscillating around the zero line for most of the week, was pushing higher. Similarly, the linear regression slope measuring trend started the week positive. Early Thursday went negative. It seemed to have bottomed out early Friday, and by the end of the session on Friday, the trend was negative, but getting less negative, approaching the zero line. So if the price action continues, then more than likely the linear regression slope measuring trend on the S&P would turn positive, and all indicators would be signaling long on stocks. It's also worth noticing that the Friday session took the S&P 500 above the top of its sideways trading range, which typically signals a breakout. So looking at the chart pattern of the breakout above its trading range, as well as the indicators that for the most part are all signaling long on stocks going into next week's trading session. Crude oil, being my last risk asset, has a similar profile but not quite exact. Coming into the week, it was flat. Saw a big drop, however, from early Tuesday into early Thursday, and then we saw a reversal, almost undoing all of the drop we saw Tuesday through Thursday, Thursday through Friday. The regression curve ribbon reflects that change in direction early Thursday. The price is using the regression curve ribbon as support, which signals to me that it's accelerating higher. Its pivot indicator, which had been oscillating back and forth from support to resistance throughout the week, by the end of the Friday trading session was signaling support. The linear regression slope measuring momentum went positive mid-Thursday and is getting more positive. The linear regression slope measuring trend, which was positive for the first half of the week, went negative early Wednesday, bottomed out mid-Thursday in line with the price and the regression curve ribbon, and started going positive late Thursday and through the Friday session. So if the price action on oil continues in the next couple trading sessions, we will more than likely see the linear regression slope measuring trend on oil turn positive, at which point we would have all four signals pointing long on crude oil, in line with the other two risk assets. So overall, the dashboard is signaling a risk on week, as we see weakness in liquidity and safety through the dollar index and the 10-year treasury, while simultaneously looking at strength in gold, stocks, and crude oil. So that tells me that investors are looking to put their money to work, assuming risk in commodities, inflation sensitive securities, stocks, and to fund that, they're willing to sell their dollars, and they're also willing to sell their 10-year treasuries. Taking a medium-term look at the grain complex, I'm seeing weakness across the board. So corn, wheat, and soybeans have all been trading lower in recent sessions, and even measures of trend and momentum are all negative. So I've got the prices accelerating lower, more so in corn and wheat than on soybean. Soybean seems to be putting in somewhat of a floor, while corn and wheat are making lows as recently as Friday's trading session. Overall, the grains seem to have fallen out of favor. But if we do get a little bit of weakness in the dollar, as forecasted by the dashboard, then we may be able to see a little bit of pickup in commodity prices, and especially if we get an acceleration higher in crude oil prices, because the grains have such a strong correlated relationship with crude oil. So now we can zoom out and look at some forecasts. So looking at the longer term chart of the dollar, the first thing I notice is that at the beginning of the new month, the dollar bumped up against a long-term regression curve ribbon. Now, if the dollar index uses this regression curve ribbon as resistance, then we are looking at a leg down back to about 89.50 on the dollar, which again, it's been down to that level twice so far this year. So basically, once a quarter, the dollar index takes a dip down to about that level. So from here, we can see a drop in the dollar. On Friday, it closed at 92.11, and it can drop as far as 89.5 before I think it's worth reconsidering. Now that level is a long-term support resistance level. The price has consolidated around this over many years. It seems to come back to this level. It's held this level twice so far this year. More than likely it holds it. If it doesn't, then we're looking at a drop down to about 87.50. But recent history shows that whenever the price of the dollar index gets down to about 89.50, tends to consolidate, tends to reverse. 10-year treasury, similar picture. It's using its regression curve ribbon as resistance. It encountered this at the start of the new month, the new quarter, and if that price level holds, we're looking at a drop from there, first down to about 132.25, but from there we're looking at a floor of about 126.75. It's a decent sized drop. It should definitely put interest rates above 2%, maybe 2.25 on the 10-year treasury. But on the longer term chart, a drop in the 10-year treasury corresponds with a drop in the dollar index, similar to the dashboard. The longer term charts are also forecasting that investors sell their liquidity, they sell the safety of government bonds, and they will in turn buy risky assets because they expect that the upside will be greater than the downside. Gold seems to have put in a floor. It dropped down to the 1775 level. It has consolidated at this level before, and it is also using the lower bound of its regression curve ribbon as support at that level. If the support level holds and gold moves higher, we're looking at a first target on gold at about 1875, and then from there on to about 2000 to 2100 an ounce on gold. And again, even on the longer term charts, this also corresponds with a move lower on the dollar, which would inversely push gold higher. Looking at stocks, the S&P 500 is at all-time highs. It recently broke above its 78.6% on a Fibonacci extension. But I do think, however, before the price gets to 4,600, it will retest the 4,300 level, confirming that old resistance is now new support, after which the market pushes higher to 4,600. Now, I acknowledge that the Federal Reserve's ultra accommodative monetary policy and quantitative easing approaches have in part led to the price levels that we are observing on the S&P 500. And in anticipation of an unwind of that policy, we can expect some of that impact to be reversed. But while the Federal Reserve is taking money off the table, the federal government, in the United States anyway, is committing trillions of dollars in stimulus and support and fiscal spending. That in itself has the ability to generate enough economic activity to push the stock market higher, even though the Federal Reserve is unwinding. You have to keep in mind that with the monetary policy approach, you basically ended up with the money that the Fed created being trapped in the banking system. A lot of the money that the Fed created as part of a stimulus approach did not make it into Main Street because so much of America is unbanked. So overall, the Fed managed to create asset price inflation in the financial markets and financial assets, and of course, home prices by keeping mortgage rates artificially low. Well, when the federal government spends money, the money actually makes it out to Main Street. So instead of the Federal Reserve supporting the shareholders of companies, the federal government will support the customers of those companies. And so I do believe that with the money the federal government is spending, the stock market can keep rallying even after the Fed starts tightening monetary policy for a completely different reason than why it rallied when the Fed was loosening monetary policy. Long story short, stocks tend to have an upward bias. If you have more than a medium-term horizon, your best bet is just to go long stocks. And because of this pre-inflationary period that we're in right now, I am convinced that I should be adding to my equity position to get exposure from increasing inflation around the world. Hence the ETFs tracking other economic regions, including Africa, the United Kingdom, the Eurozone, Latin America, and Pacific Asia. Now, crude oil has been / is accelerating higher. It is currently at a long-term support resistance level, which it's bumping up against as resistance. It hit my longer-term target of $77 a barrel, and then of course it pulled back, but it hit the target, which is also the 50% retracement on a Fibonacci. I expect consolidation. Maybe oil pulls back to 70 after a period of consolidation, depending on the inflationary outlook, as well as OPEC and their ability to toe a company line. We can see oil push above that $77, $78 a barrel. If we can get to 80, we can definitely get to 95. From there, however, historically, oil has consolidated around the $95 a barrel level. It typically then collapses. So if the price can get up to about $95 a barrel, it can easily collapse back down to 40. All in, my longer term charts are forecasting risk on. And by that, they are signaling weakness in the dollar, the 10-year treasury, and also signaling strength in gold, stocks, and crude oil. That is a similar profile to what I'm seeing on the dashboard. When I see longer term charts and shorter term charts lining up, that typically means that prices are trending. So putting those two time frames together, it just seems like we are in for a period of risk on sentiment where we see weakness in the dollar, weakness in bonds, so interest rates rising, and at the same time, rising gold prices, new highs in the stock market, and a potential move higher in crude oil. And on that note, we'll wrap it up. Today, I talked about technical analysis. I talked about the use of chart patterns, candle patterns, indicators, all of which you can learn through online courses at rtn.education. That's rtn.education in your browser. Hit enter. We offer courses on technical analysis. They're all done online at your own pace. Or you can visit me at runthenumbers.biz. That's RUNTHENUMBERS.biz, where you can browse our economic consulting services, or you can just get better acquainted with the IJS series, which of course includes this podcast, IJS Speaks, but also includes IJS Blog, IJS Reads, and IJS TV. You can learn a lot more about what we do. You can learn a lot more about technical analysis and trading, about charting. You just have to utilize the resources that we make available for you. Again, this is your neighborhood financial economist, Katie Mark. When in doubt, take profits.